If you've thought about starting a business, you know the feeling. It's like stepping onto a high wire, hoping you don't lose your footing. But while the feeling of running a business can be unpredictable, the financial reality is built on a strict rule of math. In this world, balance isn't just a goal, it's a requirement. Let's meet an entrepreneur named Jokawa. Today is day one of his brand new venture, a sidewalk coffee cart. To see if his cart is actually making money, Jokawa needs to know exactly what he owns and who he owes. That clarity starts with keeping his financial records perfectly level from the very first day. Think of this giant scale: assets on the left, liabilities and equity on the right. The left is everything the business owns, like the coffee cart. The right shows claims to that value, what is owed to outsiders, and the equity belonging to Jokawa. Every single move Jokawa makes is just a shifting of weights on this scale. The rule is simple: the scale must never tip. Jokawa starts by putting $20,000 of his own savings into the business. The cart gains $20,000 in cash assets on the left, which is balanced by $20,000 in owner equity on the right. Next, he needs cups and lids. He spends $1,000 in cash to get them. Notice that the left side doesn't get heavier or lighter. The cash block just shrinks to make room for a new block of supplies. He still has $20,000 in total value. It's just in different forms. His cash is ready to spend immediately, while his supplies are things he'll use up as he serves his customers. Now he buys a professional espresso machine for $15,000. Once again, his cash shrinks, replaced by a heavy equipment block. The scale stays perfectly still. Swapping one asset for another doesn't change what the business is worth. It just changes the shape of the weights on the left side of the scale. Jokawa needs more beans, but he wants to keep his remaining cash, so he buys $1,200 of supplies on credit. He gets the beans now, but he creates a debt on the right side to balance it out. In business, we record this the moment he makes the promise. Even though the cash hasn't moved yet, his records reflect the new inventory and the new obligation he has to pay for it later. To make sure he has enough cushion, he takes out a $4,000 loan from the bank. That cash drops onto the left side, but it's balanced by a heavy red block of debt on the right. Taking on debt grows the business's total assets, but it also grows the claims outsiders have on those assets. The scale stays level because every gain is balanced by an equal responsibility. Opening day is a hit. Jokawa makes $3,000 in coffee sales. As that cash lands on the left, he records it as revenue on the right. This revenue is the reward for his work. It directly expands Jokawa's own slice of the business's value. But he also has costs. He pays his barista an $800 salary. This expense takes cash away from the left and chips away at his own equity on the right. Daily business is a constant cycle of bringing in revenue to outpace expenses, which keeps the owner's stake in the company growing and shrinking. Look at the scale after just 1 week. It's crowded with cash, equipment, loans, and bills, and yet it sits perfectly level. This is the real secret. Every time a business gains something, it has to come from somewhere. You either trade an asset you already have, take on a debt, or use your own equity. This same rule applies whether you're running a small coffee cart or a global shipping company with thousands of employees. When you understand this balance, you're not just guessing about your success. You have the map you need to see exactly how your business is growing.